This is Daniela Cambone, and you are watching In the Lead with Jon Nadler for Thursday, August 5th. Jon, let's talk about gold's impressive run earlier this morning. It's since dropped down, but still, what was driving it?
Speculators, clearly. We've had a 5-week string of sessions during which corrections were, let's say, invisible. And it's been fueled previously, obviously, by the imminent and putative default of the U.S. on its obligations. Well, that came and went. And of course, the opposite of what was expected to happen in the wake of that deal actually happened. This morning, I think what you're looking at is overt intervention in the currency markets, which, although it bolstered the dollar quite significantly, at the end of the day shows that Switzerland, Japan, and a few other countries are relatively upset with the final deal that came out of Washington. And then on top of that, concerned with the signs that the global economy is apparently stalling out. That prompted fairly large safe haven quests, but momentum buyers are quite visible on the scene, and speculators are aggressively pushing this market towards the obvious target of 1,700.
Jon, you mentioned the word buyers. We saw South Korea and Thailand this summer continue a trend in which central banks are buying. Is this something we'll see more of?
They're relatively small in the scheme of things, 25 tons here, 17 tons there. They're basically an ongoing process, as you mentioned. It is part of domestic currency and reserve management. These are countries that have been, up to this point, relatively underweight in gold as percentage of reserves. By the same metric, we have a number of countries, especially in the middle of Europe. Italy comes to mind, Spain and Portugal certainly, which are relatively overweight, quote unquote, in gold as a percentage of reserves. So, we have to look at it within the context of what's going on in reserve management among central banks. And that's a process, and it will always result in some buyers and some sellers. So long as we have net buying, that's obviously an encouraging sign in the gold market. But we have to put that purchase, for instance, of South Korea within the context of, for instance, how much mine hedging actually took place in the first quarter, which is almost an equal amount of tons. So it's almost a net wash in terms of supply and demand flows in the marketplace.
Jon, I want to go back to what you said before. You said 1,700 gold seemed inevitable. Could it be I'm hearing such a bullish statement from you?
Well, look, if you look at the technicals and the channels within which gold is oscillating, clearly nobody is making even a mildly bearish case until and unless gold were to correct to under the 1,580 level. At which point, of course, new questions would be brought into the equation. At the moment, because of momentum, excuse the pun, clearly the signals are pointed in that direction. Whether or not we get there or how long it lasts as a price paradigm, that depends and remains to be seen. One of the issues to consider is what our friends at Standard Bank have pointed out repeatedly in these past 5 or 6 weeks, is that physical flows seem to elicit some scrap coming into the market at this level, and the virtual absence of physical buyers from key markets in India, Turkey, and so on. So we have to be careful about that, because really the paper market in New York is the driver of this buggy. But it would be nice to have a concerted effort or concerted market reflecting the same type of enthusiasm in physical.
Wow, Jon, I never thought I would hear those words from you.
You mean like actually hire something?
Exactly.
No, actually, look, if you were to ask me, I would say that the deal that was made by Obama, in my book, is lousy enough to actually allow for $2,000 gold down the road if the trend continues in this direction, and there's to allow. Now that doesn't mean that it will, but I'm extremely disappointed with the type of deal that was cobbled together, default averted or not.
All right, Jon, thank you so much for joining us. It was definitely a surprising conversation with you today.
As usual, it's a pleasure to be here, and we'll see you next week.
And thank you for watching. You can email me your comments and questions at newsfeedback@kitco.com.